to today's webinar session. I do notice that we have many new visitors to this webinar this morning, so a special warm welcome to you and thank you for joining us. My name is Monique Sharland. I am a professional accountant and specialize in business advisory and tax law for the small business sector. I'm also a franchise expert and founder and CEO of the national franchise company, Business Accounting Network, or better known as BAN. Now, this morning's webinar will provide you with a basic overview of what business financial analysis is and how it is based on management accounts for critical business strategy and initiative planning, and importantly, giving you the ability to mitigate risk by making informed decisions. So our host for today's webinar is our webinar guru, Shane Webb. As he says, he's based in Howick in KwaZulu-Natal. Just a little housekeeping before I get started. I would love to hear from you. So if you have any questions during the presentation, please type them into the question box or the chat box in your control panel on the right side of your screen. You may address questions at any time during the presentation, but I will answer them at the end of this webinar. You can download a copy of the PowerPoint slides, which is on the webinar, and Shane has indicated exactly how you can do that. We will be recording this webinar. If you would like to see the recording, it will be uploaded later today on the BAN website, which is ban.co.za. If you go to the events tab and click on client webinars. So without any further ado, let's get started. Okay, let's see. This webinar is not a substitute for professional advice, and it should be used for generalized information and educational purposes only. So before making any decisions or taking any action, you should consult a professional advisor who has been provided with the pertinent facts relevant to your particular situation. So no responsibility for loss occasioned, obviously, to any of the webinar listeners today. Acting or refraining from action as a result of any material in this webinar can be accepted by Business Accounting Network. So let's start off with the question what you should be asking your accountant. But before you ask that question, I'd like to ask you a question. You're looking at business financial analysis, and my question to you is, why do you do what you do? Why are you in business? Do you have a goal that you're reaching for? And do you have a plan for your business to get you there? Now, when one is in business, one might have a 1-year goal, a 2-year goal, 3-year goal, or 5-year goal. And you need to have a plan in order for your business to achieve those goals for you. So the solution is obviously a financial plan. You should be asking your accountant to help you with a financial plan to reach those goals of yours. That could be a holiday once a year with your family overseas, or maybe you want to purchase a holiday house that you've always dreamed of alongside the coast. But every person would have some sort of kind of goal that they would like to reach. So the solution in order to achieve those dreams is that your business needs to make a profit. So you need to ask your accountant to assist you with developing a financial plan or a forecast in order for you to be able to achieve the profit in order to reach those goals. So a financial plan should have at least 3-year projections, and it should consist of at least an income statement and cash flow projections. So the next question is, what is profit? It's all very well doing business financial analysis, but if we don't understand profit, it's going to make it very difficult. So the question is profit before or after you, the business owner, takes a market-related salary? Now, with many of the small business owners that our organization does deal with, very often would say, no, the profit is basically what's left for me to take home. And I think this is the first myth that we need to clear up right now when we venture into the business financial analysis arena. Profit is always after taking a market-related salary at least. Now, profit is on paper, it's not in the bank. And profit, or sometimes it's called earnings, needs to be normalized to be useful in business financial analysis. So when we talk about normalized or normalized earnings, it means that the profit is adjusted to remove or increase the effects of revenue and expenses that are either unusual or not economically reasonable or one-time influences. And normalizing profits helps you, the business owner, as well as financial analysts, as well as other stakeholders such as the bank or investors, understand your business's true earnings and true profit from its normal operations. So for example, if you remove revenue profit made on the sale of a fixed asset, sale of fixed asset is not part of your normal trading. Also normalizing directors or members' remuneration if they are below market related amounts. And also removing accounting entries related to IFRS for SME, which stands for International Financial Reporting Standards for Small and Medium Enterprises. Removing accounting entries such as fair value adjustments and impairments on assets and inventories and so on. And that will bring us to a true operational trading profit. But however, profit will eventually turn into cash. So it is essential, profit is essential for the survival of your business and should not be used for the sole purpose of living the lifestyle you would like to have. So for example, profit is necessary to replace fixed assets, such as the purchase of a new computer or laptop, or to pay a deposit for a new machine. But more importantly, profit is required to pay back the capital on long-term debt. That outflow of cash is not part of your expenses. It comes directly from the profit that your business makes for you. Now, a business cannot afford debt if it does not make enough profit each month to cover debt repayments. And this is why it's critical to understand that your salary needs to be part of your expenses before you measure profit. And as business owners, we see several mistakes that business owners do make when it comes to a financial plan or forecasts. And one of the first mistakes we notice is that annual overheads are not calculated in the selling price. So very often we hear that business owners or small business owners very often have cash flow problems. But in our experience, many business or small business owners, the problem is not cash flow. The problem is that they haven't costed their selling price correctly, either for the service or the products that they are selling. We also find that the business owners take out more cash than they should, or what the business can afford to pay them. So there's a lot of other issues surrounding small business owners other than a negative cash flow. And when a business makes profits, what do you have to pay as a business owner? Well, income tax. And this is something that many small business owners don't provide for either, which also creates cash flow problems when that income tax bill arrives. So a financial plan is specifically designed for you, the business owner, to identify strategies around a plan to achieve the lifestyle and goals that you require. And business financial analysis, this is the very start and the very basic start of business financial analysis. So once you have your plan, how are you going to measure your plan? You're going to measure your plan through management accounts. So if we have a look at some management accounts, just to give you an example, this is the front page of a fictitious company's management accounts or turnaround consulting. The fact that they are called consulting, this would be a service business. And we're going on to the second page of the management accounts. And just for your information, the Companies Act requires that anybody preparing management accounts, which we also call financial statements, which differ quite substantially from what annual financial statements are, they need to indicate who prepared the management accounts or the financial statements and the qualification of that person. So when we look at business financial analysis, this is the first document that we would need in order to analyze exactly the performance of your business. Without management accounts, your accountant cannot provide you with any advice or provide you with any opinions with regards to any problems you might be having in your business. So the first report that you should get from your accountant is a balance sheet, or it's also known as a statement of financial position. Now, here's an example of a balance sheet, and a balance sheet could look quite different in different management accounts because it would be designed according to your particular business. In this particular instance, we have the current month, say August 2018, compared to July 2018, and then compared to the prior period of the prior year. Now, this is essential for business financial analysis because most of the ratios are actually revolve around the balance sheet. So what is the balance sheet? The balance sheet tells us exactly what the assets are of the business, what the business owns in terms of non-current assets. That would be things like fixed assets, that would be motor vehicles, computers, machinery, that sort of thing. And then current assets, which is mostly made up of cash and what your customers owe you. Then we look at a section of what we call shareholders' equity and liabilities. That is the money that you invest in your company in order to finance the assets minus the liabilities of the company. And then we look at the current liabilities, which is mostly made up of monies that you owe creditors, and those creditors must include SARS, especially income tax and VAT and pay as you earn creditors as well. And it might include bank overdraft. You'll notice we've got taxation here of an amount due. If there is no taxation in your current liabilities, your business financial analysis ratios will be completely out, because this would throw out a lot of ratios if tax has not been provided for. The next report in business financial analysis from the management accounts is the income statement. So this would be a typical management account income statement that you should receive from your accountant, where you can compare your income month for month for month. So March 18 right through to August, we're looking at six months here of trading. You can see exactly how this business is earning its income. And importantly, one needs to look at year to date, how far you are year to date, and then compare it to last year. So comparisons for business financial analysis will basically let you know whether you are doing any better from the previous year. And in this case, we've done a huge improvement from the previous year, from 244,000 turnover to 934,000. Then you have your direct costs, or what we call cost of sales. And because this is a service business, which most small businesses are, the salaries that you pay your employees, as well as your own salary, that relates directly to the earning of the income, is part of your direct costs, cost of sales. It is certainly not an expense. So you need to make sure that your management accounts are showing the true reflection of your gross profit, which must include, as I mentioned, the salaries that are directly related to generating the income. So here we have your gross profit, and that gross profit needs to be substantial enough in order for you to pay your overheads. And this is a very important ratio, which we're going to look at just now, and any good accountant should give this to you in your management account. And that is what we call gross profit percentage. That gross profit percentage indicates a lot, or can indicate a lot of good or bad trends in the business. For example, we can pick up potential fraud or stealing in the business just by measuring gross profit percentage. What is important, you'll see this gross profit percentage is fluctuating. Of course, that is a red flag. We would have to go and find out exactly why that is happening. And then we would also compare the average of that gross profit percentage year to date. So really the year to date gross profit percentage is very important. And then we would compare it to the prior year. And we'll see that our gross profit percentage has increased, which means that this business is working more effectively than it did in the previous year. The next on the income statement is expenditure. Now, that's your overheads. Expenditure, as you can see in those figures there, are pretty much stable. There's no major fluctuations from one month to another. And it should not be major, there should not be no major fluctuations. Your rent that you pay will always be the same. The insurance that you pay will always be the same. Your telephone account will pretty much be the same. So there should be no major fluctuations there. Once you deduct your expenditure, we get to what we call the net income before tax. This is the most critical figure that needs to be calculated by your accountant when they produce management accounts, is the tax that your business needs to pay. So this business already knows at the end of August, when provisional tax time comes, they have at year to date 4,190 Rand that they need to pay for in provisional tax. Just a tip, rather take this money out of your operating bank account and put it away into a call account so that you forget about it and you have the cash available when your tax bill arrives. Now, we spoke about the financial plan and how to achieve your goals. And now we need to measure them. And this particular report is doing just that. So we are analyzing the income statement, and we are, for the current month, looking at what we actually achieved in income and gross profit and expenditure, and we're going to compare it to your forecast or your plan. And then obviously there's going to be a variance and the percentage variance. Now, for accountants, it's more useful for us to work on the year-to-date figures than it is for this month's figures. So if we look at year-to-date, we'll look at the actual achieved, and the actual would be for the 6 months ending August. Of course, the forecast or the comparison needs to be exact for the exact same period. You do need to compare apples with apples, and then we would look at some of the variances. If the variances are large, then forecasts or plans are not cast in stone. One would have to revisit the plan because perhaps we were not reasonable when we started out with the plan. So this is one of the first and most basic business financial analysis that needs to be done in order for you to achieve the goals that you would like to achieve from your business. The most important, of course, is the net profit. So our forecast for the particular month forecasted 19,000 as a profit, but we made 14,000. So we have a 25,000 Rand difference. So your accountant would assess that. They would also look at year to date, and they would assess it and see what can be done and what strategies can be put in place in order to meet the forecast. Then we have the overheads in your management accounts. That's your actual overheads for the month, in this case, August. Again, we look at year to date and we compare it to the prior year. And when we do those comparisons in business financial analysis, we obviously look at line item for line item in your expenses to see that if there's anything that pops up that is majorly different, and we might have to either check and see what it could be, or it could be a once-off expense problem, and we all unfortunately come across that. Then we would do the same thing with regards to our plan. We would look at comparing our actual expenses that we had in August to our forecast in August. And again, your accountant would be more interested in the year-to-date figures, looking at year-to-date from March to August and comparing it to the forecast and having a look at the variances. So some of the variances might be quite large, but if you look down here, you'll see that the average variance for expenses for this particular example is only 1.24%. So year to date, we've actually spent 1.24% more on overheads than what we projected in our forecast. That is actually very, very good. Even though we've got 2.13% in as a difference or a variance in the current month. Now, this is a very important report that you should get into in your management accounts. I've only completed the August figures, but generally you would have it for all the months here. And for business financial analysis, I'm going to come back to this later on in the presentation. But your cash flow statement, what is a cash flow statement? Well, basically what it is a historical look at what has gone in and out of your bank account for that particular month. So you start off with your profit and you say, right, I made a 16,844 Rand profit. I started off with a bank balance down here of 26,800 in my bank, but suddenly I'm landing up with an overdraft of 1,394 Rand. So as I mentioned before, that profit is on paper, it's not in your bank. So there's the profit on paper. What happened to that profit in order for your business to get into overdraft in 1 month? So we would analyze that. And first of all, we spend some monies on working capital or increasing working capital. And you'll see that under accounts receivable, we've actually have more customers owing us money. In other words, the money's not in the bank. The customers still owe us that money. We are financing those customers. And that net effect is that we also have not paid all our creditors. So the net effect is that because our customers owe us more, we are actually expending cash on financing those customers. So that's an outflow of cash. When we look at the movement in property, plant, and equipment, which is your fixed assets, you might have bought a computer, for example. So in this particular month, we see that a small amount has been spent on a fixed asset. Now, remembering that that comes straight out of net profit, it's not part of an expense. So here we have a cash outflow of 3,339 Rand. Then we look at the financing of the business and we see that there are shareholders' loans. Now, this particular shareholder has repaid his loan of 32,000 and is given a net effect of money that's gone out of the bank of 30,000. So the net cash outflow is 28,000. That is the reason why we started at a profit and we ended up in a bank overdraft. And the main cause of that problem was the shareholder taking out cash out of his business. Okay, so we've now had a look at management accounts and how we measure our plan and the type of reports that you should be getting from your accountant. So the next question is, why is it so important that the financial information is accurate and complete? Now, it's a very critical question that any accountant would ask before they would analyze financial statements or management accounts, which is the same thing. The question they would ask is, can I really trust the numbers that are being provided? Now, this is where small business owners are actually doing the numbers themselves. They might have internal staff or they might be producing their own accounting records themselves, and then they might come to the accountant and ask for advice as to what's going on in the business. Now, it's very difficult for the accountant to analyze it if you can't trust the numbers. Now, what we do find is small businesses, in many instances, have limited accounting abilities. And we also find irregularities as well in small businesses. So why is it important that the financial information is accurate and complete? Well, the first reason and the most important reason is to mitigate risk for yourself as the business owner. The Companies Act and the Closed Corporations Act and the Tax Administration Act, that's if you're a sole proprietor, all make it a criminal offense if you fail to keep accurate or complete accounting records. And yes, you did hear me correctly. The law makes it a criminal offense if you do not keep accurate or complete accounting records. If you would like reference to the sections of these laws and acts, you're most welcome to ask me at the end of the webinar. The second reason why it's important is rubbish in, rubbish out. If we're going to provide a business financial analysis and rubbish figures, you're not going to get the right answers and the right advice. And then, of course, we find that a lot of small businesses are using accountants partially because you think you are saving money. But by taking shortcuts, you very often miss the strategic advantage and the competitive edge, especially to reach your goals. So your accountant can't identify any problems in your business nor give you any advice unless you have accurate and complete management accounts, because accountants aren't psychic. We don't have a crystal ball. And you guys in business need more than just compliance. So this is what you would be missing if you use a cheap accountant or bookkeeper. When it comes to irregularities or instances of irregularities that we find, fraud is on occasion suspected, as some smaller businesses and companies will overstate their assets and their debtors book, in other words, what their customers owe, to access bigger loans than they would have actually qualified for. And then they struggle to repay them. And in fact, there was an article quoted by Mr. Sassoon of Sasfin, who is a lender. It's a bank, registered bank, and they mostly deal with business owners and businesses. In the Business Day this week, mentioning just what I've just mentioned now. So how can you evaluate your performance, in other words, your management accounts, to make the right decisions that will fit in with your strategies to implement your plan and reach your goals? So first off, you've got to obviously establish what those goals are. And then we spoke about a plan. So that plan sometimes is called budgets or projections or forecasts. Now, a budget or a plan would look exactly the same as your management accounts, exactly the same, except there are projections rather than actual performance. Then you need to action that plan. And once you've actioned that plan, we measure the plan by way of management accounts, which I've just shown you. And now we're going to look at business financial analysis by evaluating that particular plan. So what is business financial analysis? Well, first of all, it's evaluating what matters. And it's the process of evaluating a business's management accounts, financial statements, by using ratio analysis to see what's working, and also to pinpoint weaknesses such as solvency, liquidity, or whether the business is profitable enough to warrant investment or to drive business growth plans, from which strategies and initiatives can be performed. It's also used to determine turnaround strategies for a business that is struggling. The main objective is decision making, especially to mitigate risk in your business and for yourself, as well as planning strategies and initiative. Now, even if the financial part of the business bores you to tears, which I do know many business owners are bored to tears by financial sides of the business, and you intend to outsource as much of it as possible, you still benefit from understanding it because of the amount of valuable business information that regular management accounts can provide. So the output you receive from your accountant can help you operate your business much more effectively, and more importantly, make better decisions. So many businesses fail, small businesses fail, because the owner doesn't keep tabs on the firm's cash flow and particularly its financial position. But if you understand management accounts, you can prevent this from happening in your business. We find a lot of small business owners don't want to deal with the detail of the financial side of things. They just want to know what the answer is. And that is a problem in itself. Because if you don't understand and you're relying on an answer, how do you know that answer is correct or not? And without understanding, it's very, very hard to change your business and to implement strategies. Right, so for any good accountant professional, it's very important for the accountant to effectively analyze the financial statements of a business. But this requires the accountant to understand three very key areas. The first is the financial reporting standard that's been adopted in the management accounts. So if it's a tax or historical cost base, or if it's on an IFRS or SME basis. The second thing your accountant needs to understand is the economic characteristics of the industry in which your business operates in. Now, that's quite varied. So you could say, for instance, or for example, you could be a manufacturing business, and the one manufacturing business you might be producing, say, plastic bottles. And then there might be another manufacturing industry manufacturing something quite different. The two manufacturing industries are quite different. They would have completely different economic characteristics depending on what they're actually producing. In addition, there's other economic characters as well. For example, the difference between the formal economy and working with a micro-business economy. Your accountant needs to understand exactly what economy your business is operating in, and they would need to discuss that with you as well. And then thirdly, your accountant, the strategies that the business pursues, your accountant needs to understand what differentiates your business from its competitors. So how does your business eliminate your competition? Now, differentiation in most instances is never price. And also, differentiation in most instances is not service, because every business claims that they offer an excellent service. That does not differentiate the one service from the other service. So to differentiate your business, it's value that you need to obviously look at, and it's value or something you do differently and better than what your competition does. And your accountant needs to understand what that actually is in order to assist you when they analyze your business. So just to give you an example, if you're a plumber, you might want to offer a satisfaction guarantee. So that satisfaction guarantee could be that you'll arrive at the job on time and leave the working space clean and tidy, and offer to pay money if that promise has not been met. Or, for example, you might be a florist, and you might say, right, we have a professional writer that can craft your messages on flower arrangements for you. These are what we call value-added services compared to price and service. And your accountant needs to understand what differentiates you. So if you can make claims like this, you have an easy USP, or in other words, a unique selling proposition to hang your hat on. So what is the objective of business financial analysis, and how can it be used to mitigate risk against you personally and help safeguard the survival of your business? So decision making is critical. Financial analysis is based on up-to-date and accurate management accounts, and it's used for important risk management to enable you to make the right decision. So some of these risk factors that need to be considered are mitigating factor for directors and members of close corporations against criminal offences. Now, in both the Companies Act and in the Close Corporations Act, if you repay a member's loan or shareholder's loan, or you advance a loan to a director or shareholder or a member, then the company or the close corporation has a negative liquidity ratio. In other words, the company or the CC cannot pay its creditors when payment becomes due. And that includes SARS. That includes SARS as VAT and PAYE and VAT. Or if you advance a loan or repay a loan and the company or the close corporation is insolvent, that is a criminal offense for the director and the members. Another criminal offense that appears is paying dividends when the company or the close corporation has a negative liquidity or is insolvent. And also to mitigate risk against civil lawsuits, because your creditors can sue you or the company if you trade recklessly, and it can be proven that you've been traded recklessly. Also, detection of fraud, which I mentioned earlier. Business sustainability risk management. There's also internal risk factors, for instance, customers that are not paying on time or overstocking on inventory, or having to replace assets and making sure cash flow is available. Then detection of a death spiral. And I'm going to give you an example of what the death spiral is. And then also to access bank loans or investor funding for business growth strategies. Now, if you go to the bank and you require a loan, the bank's going to ask you for your financial statements or your annual financial statements, and they're going to ask you for your management accounts. And they are going to use business financial analysis to see whether your business can actually, in fact, afford to pay the debt. And then, of course, cash flow management, which is very critical in business financial analysis. And that will assist you in making the right decisions so that you don't harm the business's cash flow. So there are critical key elements that need to be measured. And the first and most important one that I'm going to ask you in your business, do you know what your break-even is? What is break-even? Break-even turnover, this is a minimum amount of sales amount that the business must reach to pay its overhead. So it is a sales level that the business will either make a profit, will neither make a profit or a loss. So let me give you an example. Here we have ordinary trading. In the first column, our sales of 166,000. minus our cost of sales of 100, giving us a gross profit of 66. Most important is we need to measure what the gross profit percentage is. Our overheads is 50,000, and we have, in this situation, a profit. Now, what would this business's break-even turnover be? In other words, what turnover would they have to achieve if they still maintain the same gross profit percentage of 40%? So under break-even, you'll see that in this particular example, the sales break-even amount is 125,000, which will leave no net profit. So this business owner already knows that every rand he sells over 125,000 will make him a profit. Now, your accountant can work out your break-even for you, and that's probably one of the first questions you should ask your accountant. The next and the most important critical key elements of business financial analysis is to know on a month-to-month basis the solvency and liquidity ratios in your business. So let's have a look at solvency first. What is solvency? The solvency ratio measures the ability of your company to pay its long-term debt and the interest on that debt. And solvency ratios helps you, the business owner, determine the changes and the strategies in your company for long-term survival. So let's take an example. Let's say the company's total debts over total assets ratio is 50%. This means that half the company's assets are financed using debt, and the other half is financed using equity sources. In other words, monies that you have put into the business. So let's have a look at solvency ratios in 3 different scenarios. We've got figures of the previous financial year of this particular example, and we'll see we've got total assets of 311,000. Now, remembering that shareholders' equity and loans are not included in this ratio, but we still need to know what those loan and equity amounts are. So that's why we've got a line through equity and line through shareholders' loan. But equity, we have a minus 15,665. What is equity? Equity is the accumulated loss or the retained income that the business is making month to month. In this case, because it's a negative figure of equity, it means that this business has been making losses. However, the shareholders put in 164,000 into the business, and that finances the working capital of the business. Our current liabilities are 163,000. That means the monies we owe our trade creditors and usually SARS for VAT and income tax, etc. So our total debt is 163,000. You do not include what's owed to the shareholders. And the ratio there, the solvency ratio, is great because the assets exceed the liabilities by 1.9 times. Or you could say that the liabilities are only 52% of its assets. So this scenario is a solvent business. Let's look at another example. We have assets of 249,000. We have, again, a negative equity. Again, this business has been making losses, but if you compare, it's made a little bit of a profit from the one month to the other. And now the shareholder has taken cash out of the business and reduced their loan account. The current liabilities as a result have gone up to 213,000. So let's have a look at the solvency ratio here. So we take all the net assets or the total assets over the current liabilities, and the assets exceed its liabilities by 1.2 to 1. Or in other words, the liabilities are 86% of assets, which is a bit high. Let's look at the third scenario. We've got 133,000 as total assets. Our equity is now in a positive of 45,000. That means that the business now has made profits or retained income in the business. But look what's happened to the shareholder's loan account. He's drawn money out of the loan account, and by so doing has put what we call the loan account into debit. This means that the company no longer owes the shareholder money like it did in the previous 2 scenarios. The shareholder or the director or the member now owes the company money. Liabilities are 161,000, but our total debt is 189,000, which is the current liabilities. And because the shareholder has drawn money out that exceeds the equity, we have now got an increased liability of the shareholder in the company. So our total debt is 189,000. Now we go into a negative solvency. In fact, this business is insolvent because our assets are only 0.7% to 1, or 0.7 to the ratio of 1. So our total assets of 133 is less than our debt of 189. So our debt in this case is 142% more than its assets. That is obviously a critical situation that needs to change. And the only way, and we see this quite often in small businesses, where very often the business owner can themselves put a company into an insolvent state. The only way to save this business, or one of the ways to save this business, is for the shareholder to put that money back into the business. Let's have a look at liquidity ratios. Now, liquidity ratios are probably the most important ratio that your accountant needs to do for you. So the liquidity test or ratio measures the company's ability to pay its creditors on time. And liabilities must include up-to-date provision for current amounts of income tax due to SARS. Your current liabilities must also include accurate amounts payable to SARS for things like VAT and pay-as-you-earn and skills development levy, etc. And your current liabilities must also include pro rata provisions for overheads that you pay annually. For example, you might pay bonuses to your employees annually, or workmen's compensation, and fees to your accountant for producing the annual financial statements and submitting income tax returns. All of those provisions must be included in your current liabilities in order to determine accurate solvency ratios and accurate liquidity ratios. And directors must use this test, the liquidity test, to make their decision on whether they can draw against their loan account and not prejudice creditors. Because if directors or members draw against their loan account and prejudice creditors, as we mentioned before, it is in fact a criminal offence and reckless trading. Important for directors and members to pay themselves a market-related salary every month so the situation does not happen. So the business, if the business can't afford to pay you a market-related salary, then you can't pay yourself a market-related salary. Now, when we look at liquidity, there are two different ratios that one can use. The one is called what they call a current ratio. So if you're in a business that trades in stock or inventory, it would include the inventory in assets. Now, we don't think that that is a fair ratio at all, because stock can't be sold instantly to realize cash to pay your creditors. So the most common ratio we use is what we call the asset test, and that excludes inventory. Now, if you're a service industry and you're selling time, you should also have inventory. It's called work in progress. So you might not be billing out all your employees' time in month 1, but you might bill it out in month 2 when the project is complete. That is inventory. And you need to have a system in place, a timesheet system in place, in order to actually quantify that amount every single month, because it's a very relevant amount when it comes to ratio testing for solvency and liquidity. So let's have a look at these examples. So a liquidity ratio here is only going to cover the current assets as a ratio over current liabilities. So in the first one, we are in a positive liquidity scenario where our current assets exceed our current liabilities by 1.4 to 1, or in other words, our liabilities or our current liabilities are only 69% of our current assets. Now, look what happens in the following month 3. We have the company here being solvent. However, look at the liquidity. It is in the red. It's a negative liquidity. So you can have a situation where you have a company that's solvent but is not liquid. Now, if it's not liquid, one can work on and changing that around, but it's very important that this is in this company. So our assets here of 197 is less than our current liabilities of 213. So our assets are only 0.9 of our liabilities. In other words, our liabilities, our current liabilities, are 108% of our assets. And we have a insolvent company here, and as well as a negative liquidity ratio. And this has, as I mentioned, been created particularly by the shareholder. Our current assets are 78,000 from 197, which means that he's taken money probably out of the bank account by reducing those current assets and bring the current assets down, but he has now prejudiced the creditors by taking money out of the company. So it's also important to understand when it comes to liquidity, you can't increase sales or net profit to get out of a negative liquidity. Not possible. There's only one way to get out of a negative liquidity: cash. Cash has got to get back into the business. Right, let's look at return on investment. And this is now, we're going to look at two different scenarios of return on investment. This one, we're going to look at a return on investment for you as the business owner. So if you had to take the money, instead of putting it in your business, you put it in the bank, your return on investment would be the interest rate that you would receive. Now, you would obviously expect a higher return in a business because it's far more riskier. But this is a very subjective ratio. So basically what we would do is we'd take the net profit, in this case it's a loss because we've got brackets around it, and we use it as a ratio over equity and shareholders' loan. And in this particular case, there is no return on investment. The reason being is that there is no return because this business has made a loss. Although, if you had to take the shareholders' loan minus the negative equity, there is money that's been invested. Now, if you take a second scenario where we do have a profit or a small profit, net profit in the business, and we still have a negative equity, we have a much less shareholders' loan account, but because we made a profit of 6,340, over the shareholders' loan, we have a return on investment of 17.5%. So the last scenario is we make a larger profit and we have a positive equity, but now we're losing a negative shareholders' loan account. Because the shareholder owes the company money and it exceeds the equity in the business, the shareholder has no investment in this business. They have a negative investment. So clearly the return on investment will be zero. Why this is so subjective is that if you take, for example, a service business, the service business has very little investment. The shareholders have very little investment in assets and inventory compared to, say, a manufacturing business or a retail business that would have inventory and very expensive machinery, etc. So the ROI of a service industry would be very, very high compared to the ROI of a manufacturing concern, say, or a retail outlet. And this is why it's very much a subjective ratio. So what would you do to change this net profits trend? First off, look at the sales. It's increasing month or year on year. And of course, that's a good thing. But look what's happening to the net profit. It's decreasing. So the question is why and what's happening. So your accountant will come along and they will use the ratio of gross profit percentage and they will see, whoa, we have a problem with the gross profit percentage decreasing. Now, even though the expenses go up, a lot of small business owners just focus on that and say, well, my expenses have gone up, hence the reason why I'm not making a good net profit. This has nothing to do with expenses. And very often we measure the wrong thing, and small business owners measure the wrong thing. Expenses is very rarely the problem. In this particular case, it's the gross profit here. So let's say we maintain the gross profit percentage in our first year of in 2016 of 60%. Look what happens if we can maintain the gross profit. Our net profit increases, and accumulatively, look how much it increases by. So your gross margin percentage is a very important measurement to see where there could be problems in the business and how to rectify it. Right, we're going to talk about what we mentioned earlier is the death spiral. And this is the first signal of business distress that your accountant could pick up. So I'm sure some of you might have heard the saying, growing too fast, you'll grow out of business, or rapid growth. Many business owners fall into the trap of thinking that all you need to do is to increase net profits by increasing your sales and cutting your costs, or both. And you will suddenly have all this cash you need. Now, too strong a focus on net profit and sales usually leads to the tendency to ignore the business overall investment in assets. So your business cannot make money for you if your investment in assets increases at a faster rate than your net profit. So I'm going to repeat that. A business cannot grow its assets at a faster rate than its net profit. Now, when we look at assets in this particular scenario, we are going to look at return on investment. And the assets that we are concerned about here are what your customers owe you, in other words, accounts receivable, and inventory or stock. And if you are a service industry, you would have inventory by work in progress inventory. So let's take a base month, month 1. We start off with sales of $1 million. And look how our sales are growing. So we're all very happy. We're concentrating on sales and we're doing very, very well. Nice pat on the back. Then we look at our net profit, and our net profit is also increasing. From month 1, 10,000, 11,000, 12,000. So we're doing very, very nicely, or so we would think. Look what's happening also with our current assets. Our accounts receivable, which is what our customers owe us, plus inventory, or as I said, if you're a service business, you do need to measure your work in progress. And to be expected, if your turnover is going to increase, obviously your customers are also going to owe you more, and that is the increase from month for month. But now your accountant comes along and they do what they call an ROI ratio, return on investment ratio. And we are looking, as I said, in this ratio, customers and inventory. So if we use base month 1, we've got a 10% ROI. But look how that ROI is decreasing month on month. That is a huge red flag. As much as this business is growing and doing well, it actually isn't. Now, let me show you why it isn't. And this is something that very often can be turned around, and very often a business will go into business rescue for this very reason of what's happening right here. So the reason why this is happening is that the assets have increased. So we started in base month 1 with 100,000. It increased to 112. So it increased by 12,000. And then the following month, it increased to 125,000 from 112. In other words, it increased by 13,000. But look at our net profit. Our assets have increased more than our net profit, because our net profit in monthly is 11,000 as opposed to our asset increase of 12. This means that the business's cash is financing its customers in excess of its net profit. So in this instance, the first month by 1,000 Rand. So in other words, the business has had to find 1,000 Rand to finance its customers and finance its inventory. Now look what happens in month 2. We make a 12,100 Rand profit, but our assets have grown even more, which means 1,340 Rand to finance its customers and finance its inventory. Now, what happens, and this is why we call it the death spiral, is because this is an accumulative cash shortfall month on month. It adds up and adds up. And can you imagine what would happen if this trend continues? This business will have no cash, it will become insolvent, and you'd have to liquidate. So this is probably one of the most important distress signals and ratios that any accountant needs to do for you, and it needs to happen in management accounts on a monthly basis, because it will be too late if you wait 18 months down the line when you have your annual financial statements prepared. Now we're going to look at a cash cycle. Let's say you want to grow your business by 20%. And your existing sales is 3 million, and you want to grow your business up by 20%, and your projected sales is going to be 3.6 6 million. How are you going to find the cash to grow your business? Now, a lot of business owners don't realize that growth of a business requires funding. So your accountant will come along and say, right, let's have a look and do a ratio on how long it takes you to sell your inventory. So in this instance, we're using an example. It takes 90 days in order to realize cash from your inventory. Then we take our customer day, our receivable days. How long does it take on average for your customers to pay you for the money to go into the bank? And here we're using an example. It takes 50 days for our customers to pay us. And then how long does it take for you to pay your creditors? So usually you must obviously try and keep up to date with your creditors, particularly that you pay them on time. So the inventory days plus your receivable days minus your creditor days gives you something what we call a cash cycle day. So in this example, it's 110 days before you actually realize cash into your bank. Now, if you have a 3 million rand turnover and your cash cycle days is 110 days existing, you would need cash in your bank for financing a 110-day cycle of 904,000 rand. If you keep those cash day cycles exactly the same, increase your business to 3.6 million, you will then need cash in your bank to finance your cash cycle days of just over 1 million rand. So to grow your business by 20%, you're going to require an additional 180,000 rand to finance that growth. So I'm going to show you without having to get investors or give away equity. So we're going to, but now what we're going to do is we're going to buy inventory much more wisely, and we're going to reduce that to 80 days. We are going to get a crack-ass credit controller to get monies from our customers to make sure they pay on time. So we're going to reduce that to 40 days. We're not going to mess around with our creditors, of course. That will stay exactly the same. So we reduce our cash cycle days to 90 days. Look what happens. The cash that we need in the bank to finance 90 days on a turnover of 3.6 million is 887,000. Don't worry how I get to these figures. This is something that your accountant can do for you. But look what we've done. We found money not only to grow your business, but extra in your bank of 197,000. So you can actually grow your business by 20% and actually find 197,000 in addition to what you didn't have previously. Right, here's a nice easy exercise to see if your business is making money. And what you can do is you can put this on an Excel spreadsheet and monitor every single month these particular figures. So in month 1, you would monitor, say, your net profit, or if it's a loss, it would be in brackets. Hopefully it's not a loss. And month for month, you would then put in your percentage change. Next, you would measure your customers, what they owe you, plus any inventory at the end of the month that you have. And you would then work out your ROI ratio, or your accountant can work out your ROI ratio. This is to detect immediately if there's a death spiral or if your business goes into distress. And this is over and above your management accounts. Then what you would do is then you would look at your cash flow every month. So that example, when we went through the management accounts earlier, you could see that there was a cash outflow of 28,000, if you remember. You would put that figure every single month as your cash inflow or outflow, so you can monitor the different changes. When you put something like this onto a spreadsheet, it immediately brings to your attention any problems there might be. So the cash flow amount that we take here needs to come from your management accounts that your accountant has produced for you. Right, that is all with regards to we have at the moment for business financial analysis. I do want to mention, however, that we've only touched on business financial analysis. We will be bringing up another session eventually. Let me go to the next screen on business financial analysis as it relates to cash flow, particularly. So we have to will determine the date that that's going to be on. So it's going to be called Cash Flow Turmoil, Finding and Terminating Monsters at the Bottom of the Deep Dark Cash Hole. We'll either be holding this in November or in February next year. And our next month's business webinar is what I have to pay tax on no real cash income. SARS goes for gold, tax on directors and members' fringe benefits, and deemed dividend withholding tax. That webinar is going to be hosted by my colleague, Madeleine Pretorius, on the 26th of October. So do diarise that date. It's going to be, again, for an hour between 9 and 10. Shane, are there any questions that anybody has for me? And allocate stock on hand in terms of financial planning. And that's a question from Jeffrey. So Jeffrey, I'm not quite sure exactly what you mean in terms of financial planning and how you handle stock on hand. But if I do understand correctly, when we do financial planning or projections, we basically use the gross profit margin basis in order to determine that stock on hand. So it will then calculate immediately what that stock on hand should be every single month if you meet those margins in your projections. I'm not sure if that is the question that you did ask, but if it is, I hope I have answered it. Okay. Determine what method to use for stock valuation. Okay, so I'm not quite sure what you're referring to. If you're referring to stock valuation in annual financial statements from an accountant's point of view, or if you are maybe referring to a financial plan projection and how you determine stock in a financial plan projection. But the valuation of stock, if you're looking at annual financial statements, needs to be the cost price, and obviously less any impairments. So here's the question that's come up on the screen now. So the stock valuation, as I said, is cost price, less any impairments. Now, impairments means that if you aren't able to sell the stock, and the stock you've purchased, the cost of that is actually going to be lower than the selling price, you need to impair that. So in other words, fair value the inventory. Now, that's from an annual financial statement point of view. When it comes to management accounts, that stock needs to come from the actual client's system or the business's system. So they should run a proper integrated stock inventory. And this is an area, I must say, that us accountants find with small business owners is very, very often inaccurate. It depends what system they're running. So let's say they're running an integrated inventory on Pastel. Pastel will work out an average cost. But the problem is that certain settings on these software systems, because the business owner doesn't understand them, they sometimes allow these stock items to go under zero, or get the stock items to go below zero. So it is very important that the accountant does, in fact, and we have certain methods in place to make sure that when we do management accounts and prepare management accounts, that we get the stock as accurate as possible. But one of our suggestions when we prepare management accounts is that the business owner must take physical stock take and check it against his system, particularly the cost prices and the quantities, at least every quarter. And that would probably be the best way to try and get as accurate as possible management account figures. I hope that's, that assists you. Oh, I see. So I see your next question. You've asked between FIFO methods and weighted average. Okay, well, that all absolutely depends on the stock system that the business owner is using. Now, the weighted average method is always used by systems like Pastel, for example. That is always a weighted average method. And there are other systems that do the FIFO method, which is first in, first out method. So you could take either one of those methods and use either one of those methods to determine your inventory at the end of the month or end of the financial year, as long as, of course, your accounting policies refer to the correct method that's been used. I hope that answers your question. Unfortunately not. All our templates in Business Accounting Network are copyrighted, and it is the intellectual property of Business Accounting Network. So we don't have specific templates, but also just to add that, every business is different, and the way you're going to set up management accounts is not necessarily the same for every single business. So you do, as an accountant, have to apply your mind to how you are going to report to management. They can't, every report is not exactly the same. What I showed you earlier this morning is just a very basic example of management accounts, but they can become a lot more complex depending on the information that needs to be analyzed.